I'm Ramzan Karmali. Well, data out this week once again highlighted weakness in Europe's largest economy. First, PMI data suggested that the country is now in the middle of a technical recession. Then the IFO Institute indicated that there's been another fall in business morale this month. And later this week, we expect that a number of Germany's leading economic bodies will downgrade their growth forecasts for 2024. So will the German economy drag down the whole of the Eurozone? And what can be done to get it back on track? Well, to help answer that and more, I'm joined by Dr. Holger Schmieding, Chief Economist at Berenberg. Holger, thanks so much for joining us. So from the data releases we've got this week, are we right to assume that Germany is in a recession?
Well, the German economy seems to be stagnating with a significant risk of a recession. If you define recession as 2 quarterly declines in GDP in a row, we had a slightly negative second quarter. There is a significant probability that the third quarter could be slightly negative as well. So technical recession is quite possible. But as these are small declines, the better description is Germany, the economy has been stagnating for more than 2 years. And so far, there is no improvement in sight. Near term, the risks are to the downside.
So are Germany's economic woes in danger of dragging down the whole of Europe with it?
Well, to some extent, yes. Germany is the pivotal economy, the big one in the middle of Europe. Germany's industrial weakness, of course, has ramifications for the rest of Europe. But before we talk too much about Germany and look at the label sick man of Europe, remember, Germany is having its problems at an extremely high level. It has record employment with an employment rate 10 percentage points above that of the rest of the Eurozone. It has the best budget of almost any country in the advanced world, save Switzerland and Norway. So Germany is having serious problems, but at a very high level.
One area, though, that it has hit the German economy quite badly has been industrial action. And now there's the threat of Volkswagen workers also going on strike. How do you summarise this impact this has had on the German economy?
Well, so far, these industrial actions do not have a major impact on the economy yet, and they seem to be far out of place. It's industry that is feeling the brunt of the Chinese onslaught, of heavily subsidized Chinese competition, of Germany losing market share in China and losing market share to China on global markets as well. I think that actually for many companies, industrial action at the moment is not that threatening because they're not running at full capacity anyway. The likely outcome is actually wage moderation for next year, especially in industry. There is no other way out.
You brought China up there. Is there a danger here that policymakers have got it wrong again, especially if you look back to the energy crisis that we had? They got it wrong again by relying too heavily on China?
Well, that is, of course, a matter of the past. Germany had in the past relied probably too heavily on China. It had relied too heavily on cheap energy from Russia. But this is not the core of the problem. The issue is simply, does policy give incentives for investment in the country? The multitude of small and medium-sized companies, the Mittelstand, they are basically financially still mostly in good health. They are currently, however, hesitating to invest in Germany because all this noise about government policy, this noise about there is no money, we have the debt break, all this is retarding business investment. If we can get that cleared up, if we have a clearer outlook for energy policy, for fiscal policy, for social policy, then probably business investment in Germany would revive because companies are actually fairly good.